All right, welcome to the 2nd of October. It's looking like it's going to be quite a day for the markets, but we're going to leave that in the background. And the focus of today's session is going to be how I decide where to focus my time before I really drill down into the nitty-gritty of a stock. How do I understand in a few minutes to, let's say, an hour, which stocks are looking as though they are over or undervalued? So whether I maybe decrease my holding in a certain stock or bump it up. Okay, so the news of the day: Trump has caught the Rona and pushing the market lower. Indexes are down, particularly tech. Well, the Nasdaq 100 at least, and I'm going to be putting some time and money into tech stocks later on today. Now, valuing stocks, I know this because I felt this way at one point. It feels like it can be quite a difficult thing to understand, a complex topic, and I guess it is. There are a few different inputs, a few different ways to value businesses, and understanding the impacts and the implications of each takes some time. But actually, the math involved is very, very simple. Peter Lynch is one of the greatest investors of all time. And I mean, to understand stock valuations, at least in terms of fundamentals, you basically need addition, subtraction, multiplication, and division. Looking at some of those now, the Wikipedia article on stock valuation is a really good place to start. So here you can see a number of different methods, and quite often analysts, me included, will combine a number of different methods because any one they all do have their flaws. They all have pros and cons. Some are complex, some are simple, and they all give you slightly different views on a business and its health and its ability to grow and the way that it's performed historically. I'm not going to drill into some of these discounted cash flow analysis. You can get calculators on the internet or Excel spreadsheets and plug in various pieces of data. Probably the most commonly used is price to earnings ratio. This is very easy to calculate and often is done for you. Earnings growth is another one that's very common. And there are some others here: price to sales, market cap, enterprise value, EV to sales. I'll talk about a few of them in a little bit of detail in a moment. So if any of these did take your fancy, I would recommend going to Stockopedia and searching for that particular method. They usually are very good. They have worked examples and they can tell you the pros and cons of those approaches, where their shortfalls might be. And the Motley Fool is another really good place to look. Before we get into the nitty-gritty, what drives the value of a business? What the stock price, at least. And the stock price is made up of many different attributes, but ultimately, probably the two most important attributes are the amount of profit that company is making, or the potential profits that company will make in the future. And this is multiplied by effectively the multiplier that the market decides on top of that company deserves. So if a company is making $1 of profit per share today, but it is a high growth business and the market thinks that it's going to grow 10 times in the next year, they might value the stock of that business at 10 times the amount of profit it is currently making in anticipation of the profit that it will make. All right, so some of the key points in valuing stocks are: you need to look at the history. Obviously, you can't base everything on history, but you need to start there. So has the company shown good revenue growth? Have they shown good profit growth? So can they make a profit out of the revenue that they're making? Have they not taken on too much debt? This kind of depends on the type of business. So if you're a car maker, your business is capital intensive. So in the first decade to 2 decades, you probably are going to take on quite a lot of debt. So it depends on the industry to some degree. And have they shown the ability to turn money into more money? So if they have taken on debt, if they've taken investment, have they been able to efficiently make that into more revenue and more profit? And then the stock price of a company is forward-looking, almost always. So besides the history, we need to understand, does the company have good potential to grow their revenue, good potential to grow their profit? Do they have plans to take on huge amounts of debt in order to achieve the first two? And do we think that they can continue to turn money into more money? And so examples here might be Apple is a company that historically ticks all the boxes, sitting on a huge pile of cash. But the growth has started to slow. As companies become big, as they saturate the markets for their products, their growth slows. And so the growth of profit, the growth of sales slows. So we would expect the stock price growth to slow. However, if we look at the market cap, so the total value of all of the stocks in the market that belong to Apple, they've doubled in value in 1 year. So is it fair to give Apple this stock price, to award them this value on their stocks? Did they really double in terms of their ability to make revenue and profit in the last year? Well, that's something that we need to look at. So that's the big question. Has the market somehow distorted the stock price too much? And it's not just up, by the way. They can also do it down. So sentiment can mean that for some reason the stock has fallen out of favor. And these are the little treasures that you hunt for. If you can find those that are significantly undervalued, that's great. All right, so how do we answer these particular questions? And there are lots of different tools on the internet. Some of the tools that I use are paid, by the way, so you might not have access to the same level as me, but you can get to this data for free. It just takes a little bit more effort than you get if you pay for the tools. So I wanted to take a look at Facebook as the example of valuing a stock. And so here on Seeking Alpha, I've compared it against a few different stocks. Obviously, Facebook's stock price has grown fantastically recently. And by recently, I mean in the past year, not in the past few weeks. So if we zoom out, let's change this to the week view. That's a pretty steep climb in terms of stock price. You know, there've been some bumps in the road, but it's increased quite nicely. So let's say we want to understand, is Facebook a good buy right now? And I probably wouldn't use much of the information at the top of this, and I might ignore some of this because I want to determine my own rating. Seeking Alpha does a few things for you. So it has its own value, growth, profitability kind of categories, and it gives you a rating. So right now, Seeking Alpha, using some of the information that we see here, some of the commonly used pieces of information, they're saying the value, and by this they mean the stock price, the expensiveness of the stock price, the value of the stock price versus the value of the business. Facebook and all these others are looking very expensive. That's effectively what it's saying. The business is growing nicely, and I think that their growth measurement is a combination of revenue and earnings. So pretty good. Not as good as Netflix, but pretty good. They're highly profitable. So they're able to turn money into more money very well. And I think this is probably a measure of margin is in there. Momentum, so how much is the stock moving in a certain direction? In this case, probably up. And EPS revisions, I think this probably means how many times are the earnings per share revised upwards through the year. So right now, Facebook is looking pretty good, except that according to Seeking Alpha, at least, it's looking quite expensive. Momo, on the other hand, I don't know if many of you know, but Momo is a Chinese social network. So the value in terms of the stock price relative to the amount of money that they make is looking really good, but growth is bad, momentum is bad, EPS revisions have been down. So I know this business fairly well. And below here, we'll see a lot of abbreviations, which I guess they're very intimidating at first glance, but I would probably focus my time on the price earnings ratio and the PEG ratio. So price earnings ratio is literally what is the price per stock, 1 unit of stock, divided by the amount of earnings made per share. And so this tells us that the market right now is valuing Facebook at 33 times the amount of profit that they're making today. So there are a number of ways to interpret this, but you could also read it as the market thinks that Facebook is able to grow 33%. It will grow its earnings 33% over the next year. When you look at Facebook historically, that is something that could be done actually. So here we can look at all the different points in time. So growth is a key element. So revenue growth has been 20% year on year. Forward growth is looking similar. This is a measure of profit, but let's look at net income. So net income profitability, roughly 21%. So the price earning ratio is not too far off. In terms of their profit margin, this is spectacular. It's very hard to find a company with a profit margin that high, as you can see is fairly obvious here. And so these elements are telling me that Facebook is expensive, but in terms of their growth and their ability to turn money into more money, and especially relative to their partners, to their competitors, maybe they're not that bad. Google is not growing their revenue by that much. Google's profit margin, although eye-wateringly high, is not as high as Facebook's. So Facebook, at least relative to its competitors, is looking fairly good, if somewhat expensive. So you might buy Facebook now, expecting to hold it for several years, and if things keep on going like they have, you're probably going to make some money off of Facebook. All right, so points in time are very interesting to look at. We also need to think about what we know about that business. So Facebook, we know that there's some controversy. So there is a chance that the business might be broken up, which would be bad for them, obviously. But there are other things. Instagram is still growing massively. They've created a shop feature directly out of it. Revenues and profit out of that part of the business are growing quite nicely. They are looking to expand their footprint in lots of emerging markets because their emerging market footprint is small, growing rapidly. Their share of wallet in emerging markets is still quite small. And Facebook is looking to get into virtual reality. They've just released a new version of the headset, which is much smaller and wireless. And the move to work from home is probably going to favor that quite nicely. I don't know how many of you have used virtual reality headsets. I have a PlayStation 1 and it's incredible. It's definitely the future. So Facebook, in terms of their potential, I think is quite good. Fundamentals looking pretty good, a little bit expensive, but not too bad. Whereas Momo, which is looking cheap at the moment, has a lot of risk. And I know this because the Chinese government issued a new version of the way that advertising needs to work on social networks, and this has impacted Momo, and they're trying to climb their way out of a hole, rework all of their technology, limit the kind of ads that are available on the network. So they're a risky stock. They're looking cheap, but they're much higher risk than I would say Facebook is at the moment. Stockopedia is another tool that I use to get a point-in-time view on stocks. But what can be a lot more interesting is the trend over time. And so going back to these key points, looking backwards, has revenue growth been good? Has profit growth been good? Etc. etc. You're able to get a view using tools like macro trends and for the stock in question, but also against competitors. So revenue for all three of these businesses has been very good. Apple's done better than the other two. In terms of profits, they're all doing pretty well. Earnings per share is not really relevant. Their margin, so this is the amount of profitability that they can make, is good. And the reason that this is interesting is that as businesses become bigger, their ability to turn revenue into profit usually decreases. And you can see that that's happened for Microsoft, although they've had a bit of a bounce, in Google. So these businesses are becoming less profitable. Well, yeah, all of them are becoming less profitable as they become bigger, which is an important attribute when valuing a stock. And so, again, looking at the trend, but now just for Facebook, looking at the revenue, all going up. But what we also need to consider is that revenue growth is on its way down. So whilst they've grown nicely, the amount by which they're growing is slowing down. Like I mentioned before, also profit is slowing down. So it's becoming more difficult for these businesses to make more money proportionately. And so when you do start looking at the price, you want to compare the growth in the price to things like the growth in the profit. And that's where the ratios start becoming quite insightful. So Facebook's price is increasing, but actually the profitability has been relatively flat for a few years. So actually, in 2018, the profit per share was very similar to what it is now, but the share price was much lower. So why has Facebook's share price increased if its profitability hasn't increased by that much versus 2 years ago? And that's where we need to start looking at the potential of the business in the future. All right, so I'm not going to drag on for too much longer. Some of the key ratios, and they're right here for you in macro trends, are the PE ratio. So you're trying to figure out, does this business deserve the stock price valuation that it has right now? So based on how much money it's making, how much it's growing versus the stock price, does it deserve to be where it is today? So I would say, for example, on Facebook, it is looking a little bit expensive, but I also know that the current economic climate, the current lockdown, will favor Facebook quite a lot. People are spending more time online. They're selling more things online. So Facebook's footprint with sellers and with individuals is only going to grow. Also, their move into virtual reality is probably going to expand their footprint in a few other areas. They are still a growing business, although the growth is slowing. And the price earnings ratio is fairly high. But looking at the historic price earnings ratio, it has historically been much higher than it has at this point. So we do expect a few corrections as we go along. But if you're buying it for the long term, you're probably going to be okay. I was going to go through this in a bit more detail, but I think I've gone on for long enough. So these are just a few of the charts when I would use when I would compare various different competitors. So this is taking different measures of the business. So the amount of revenue they're bringing in, the amount of profitability they're making, what is the growth like in each of those areas, and then charting competitors within the same industry using those common criteria and trying to figure out within that group at least who might be the most overvalued. And so we need to shed a few of those stocks if we have them, and who might be the most undervalued, and therefore we want to pick up a little bit more. All right, if you have any questions, I know it's a complicated topic with a number of different inputs. I'm happy to take questions, so just fire them over. All right, have a good weekend.